Hello everyone and welcome back to the world of finance. Friends, in this class we are going to discuss something very important in the field of fixed income securities, or what you can call as bond valuation. That is the concept of convexity of the bond. What is bond convexity? How it is measured? How it is implicated, that means how it is applied and what is its real utility. We are going to learn all this in detail, and that too in a very simplified manner. Now let me tell you, if you have been watching my videos all the time and you are already a subscriber to this channel, that is fantastic. If not, then identify this channel and don't forget to subscribe this channel, because this will bring about a lot of conceptual learning in the field of finance, particularly for CA, CMA and CFA students. And not to forget this bell icon, don't forget to push that as well, because this will give you complete notification about as and when I am coming up with new recorded videos meant for you. What exactly is the convexity of the bond? Before I get started with that, let me just help you recollect what we have learned in the earlier classes. In the earlier classes, we have learned about sensitivity and volatility of the bond. Now, what is meant by sensitivity and volatility and how these are measured, we have learned that. We have learned one more aspect, that the value of the bond has inverse relationship with the yield rate. If the yield rate changes, the value of the bond will change. And inverse relationship means if the yield rate rises, the value of the bond will fall. If the yield rate drops, the value of the bond will rise. So how much is a bond sensitive to a given yield rate? In other words, what is the sensitivity, what is the volatility of a bond price with respect to the yield rate? That is what is measured by sensitivity and volatility. And basically, you know, sensitivity and volatility are almost similar things. Volatility is the degree of sensitivity expressed for each rupee of bond value. Now, what is convexity? We are going to talk about that. So if you can identify that the bond value has an inverse relationship with the yield rate, if we plot the relationship graphically and take yield rate on the x-axis and the bond value vertically on the y-axis, with the increase of the yield rate, the value of the bond will go on dropping. Now, when we plot this graphically, it will be a trend that will slope downward. The question is it a linear trend or is it a curve? If it is a linear trend, let us assume for a while that it is a linear trend. If it is a linear trend, then something sloping downward, one point it will intersect the x-axis. Imagine on the y-axis you are considering bond value, on x-axis if the trend intersects, it would mean that the value of y at that point will become 0. Means at a certain desired yield rate, the value of the bond will become 0. Now this is an impossible thing. Why am I calling this as impossible thing? Because no matter how much is your expectation as an investor, no matter how high the desired yield rate goes, the value of bond can never go to 0. That means it is impossible that this trend is linear. Now it is clear point that the nature of this interrelationship, which is inverse relationship, but it is not a linear relationship. If you plot it graphically, it will be a curve, and that curve will be convex to the origin. I'll show that graphical presentation in a while, just keep patience. So if the curve is going to be convex to the origin, you know what is the difference between a straight line and a curve? Mathematically, a straight line has a constant slope, whereas the slope of a curve keeps on changing. You know, measuring convexity actually means measuring the rate of change in the slope of that trend. and that indicates convexity, because when you plot that curve will be convex to the origin. So let me now take you to some notes writing part and the graphical presentation that I was talking about. So carefully note down this. It is known that when interest rate expected by the investor changes, the value of the bond will also change. The desired yield rate and bond value are inversely related to each other. Therefore, when desired yield rate increases, the bond value declines and vice versa. When this interrelationship is presented graphically, the outcome will not be a straight line but a curve which will be convex to the origin. Alright friends, moving ahead, I would want your attention over here that when we are talking about measuring the bond convexity, look at this graphical presentation. As I have explained you, desired yield rate or simply the yield rate is taken on the x-axis, intrinsic value of the bond or simply bond value is taken on the y-axis, and now that we know that the interrelationship of bond value with the desired yield rate is an inverse relationship such that as and when the desired yield rate rises, the value of the bond is going to decline, the trend will slope downward. We have also observed that this is not going to be a straight line. As a result, you will be finding a curve which is convex to the origin. Now, what exactly is meant by measuring the bond convexity? Look at the slope of this curve initially. It is so steep to the vertical side, right? But if you look at the later end, the slope is not that steep vertically. That means from here to here, it is not having a constant slope. It is continuously having a change in the degree of the slope. Now, let me highlight this point that measuring convexity is measuring the rate of change in the slope of this curve. Now, when we talk about the measurement of bond convexity, let me show you the convexity formula. Now, by appearance, it may appear to be little complicated, but don't worry, it is not that complicated as it appears. So how do we measure this bond convexity? Let me first give you an idea. It is 1 divided by P into 1 plus Y the whole square. Y indicates the desired yield rate. So 1 plus the yield rate whole squared multiplied to P. P indicates the bond price or the value of the bond. Now, this Y could be either YTM or the intrinsic value of the bond. Just keep in mind one thing, if Y is the desired yield rate, then P should indicate the bond value which is the intrinsic value. If you are considering Y as YTM, then this P should be the market price of the bond. Just take care of that. Now, this term needs to be multiplied to the summation of this whole thing. Now, what is this whole thing within the brackets? It is the cash flow at time t divided by 1 plus yield rate raised to t. You know, actually this term, it is nothing but the present value of the cash flow multiplied by t square plus t. So you find this term and then take summation for each year, that is year 1, 2, 3, 4 and so on up to this capital T as the limit, which will indicate the remaining years to maturity of the bond. So gap of T will be one time period, which will be generally as 1 year if it is annual coupon paying bond. So for any change in the value of T, that is T could be 1, 2, 3, 4 so on up to the limit of T. So you do one thing, you write up the variables defined over here. P stands for bond price, Y is YTM or yield to maturity. Once again, let me tell you, in any case, if Y is considered over here as not yield to maturity but the desired yield rate, then this P over here, instead of considering the bond market price, you will actually write it as intrinsic value of the bond. Then T is the remaining years to maturity and CFT is the cash flow in time T. Now allow me to simplify this for you. So what is to be done? If you carefully observe this whole thing, As I said, this is cash flow in first year divided by 1 plus y raised to 1. Then cash flow in second year divided by 1 plus y raised to 2. Cash flow in third year divided by 1 plus y raised to 3. So on and so on up to maturity of the bond. So this is basically nothing but the present value of the bond cash flow. So I would identify this term as, in simplest words, the present value of the cash flow from the bonds. This term, which is to be multiplied to this present value, will be t square plus t. If I take t as common, what do I get from this term? It will be t multiplied by, within brackets, t plus 1. Now, if we use these terms instead of the actual formula, the formula will appear to be little simplified. Look at this. Convexity can be measured as summation of this term, t into t plus 1. So summation of t into t plus 1 multiplied by present value. So you have to take t into t plus 1 multiplied by present value for each year and then take summation of the same, and then this whole thing becomes the denominator, that is 1 plus y the whole square will be multiplied to the bond value or the bond price. The big question that now arises is, why are we computing this convexity? What is the role of this convexity? Where are we going to apply this? This is something important. Application of something that you have determined is important. So in the previous classes, we have talked about the application of bond sensitivity and volatility of the bond. If you can recall, with a given change in the yield rate, through volatility, if you try to find the change in the value of the bond, you actually get an approximate change. So using sensitivity or volatility, the change in the value of the bond appears to be an approximate value. What can be done to adjust it to almost accurate? That adjustment is what we call as convexity adjustment. Let me do one thing. Let me once again explain this to you through a graphical presentation over here. Look at this graph where it is the interrelationship between the bond value and the desired yield rate. You know now one thing, that it will be a trend sloping downward which will be convex to the origin. If I find a particular point like this, and over here I would want to identify the current desired yield rate, and at this place the bond value would be something over here, and if I consider that as a tangent and draw a straight line sloping downward, this has an intersection point over here which may indicate the current scenario of the yield rate, which is assumed to be 10%. At 10% yield rate currently, the value of the bond is so much. If the yield rate falls down to 8%, the value of the bond will obviously rise. Look at one thing. From this point, if the desired yield rate has reduced from 10 to 8%, the value has risen from this level to this level. But do you know what? This dot that I have placed in the blue line, it is a straight line. So when you apply the volatility adjustments, you actually come up at this particular point, which is not the true indication of the bond value, because the bond value will be on the curve and not on that straight line. So the vertical gap between these two dots actually indicates the convexity adjustment. Once again, if we go to the higher side in terms of yield rate, and if the yield rate rises from 10% to 12%, what would happen? The value of the bond will fall. Look at the fall in the bond value. But again, this fall, which we can determine through application of sensitivity or volatility, will be an approximation on this straight line, but the actual value of the bond will be on this curve, correct? The vertical gap between these two will be what we call as convexity adjustment. So keep in mind one thing, in this graph, V is bond value, Y is the yield curve. So for your reference, if I just zoom in this graph, can you closely observe that on the blue line where the dot lies is the approximate bond value which can be assessed through sensitivity or volatility, but the actual value of the bond will be on that red colored curve, which is indicating the application of convexity, and the vertical gap between the two is actually the convexity adjustment that we need to carry out. So let us now understand the application of convexity through convexity adjustment and how to determine convexity adjustment. The convexity adjustment can be done by taking half of the convexity that you have determined. So you have learned how to determine convexity. You take half of the convexity multiplied by delta y square. Delta y indicates the change in the yield curve squared and multiplied by 100. The resulting convexity adjustment will be in percentage because you have multiplied 100. If the yield rate increases, the bond value will fall. So percentage change in the bond value will be volatility multiplied by delta y, that is the change in the yield rate, and from that you subtract the convexity adjustment. When you subtract this convexity adjustment, you will be getting the actual bond value. If the yield rate decreases, the bond value will rise. So percentage change in the bond value will be volatility into delta y plus convexity adjustment. Now you understand one thing, you are adding convexity adjustment over here and subtracting convexity adjustment from here, because here the bond value tends to fall and here the bond value tends to rise. Alright friends, now what we do is to understand the convexity adjustment, that is the entire application of convexity, let us take a nice calculative example given in question number 24. Let us read this question. Face value of the bond which is redeemable at par is given as 10,000. Yield to maturity of the bond is 10% per annum. Coupon rate payable at the end of each year is given as 8% per annum. Life of the bond is given as 5 years. You are required to determine the following: bond value, volatility and convexity of the bond at yield rate of 10% per annum, revised value of the bond directly through volatility if in case 1 yield rate rises by 2% or yield rate falls by 2%. Compare the computed bond values with and without volatility in each of the above cases. And last requirement is required convexity adjustment in each of the above cases. Now the question arises, how are we going to approach this entire question? So the first requirement in the question, it is asking you to compute the bond value. So your yield rate is 10%, bonds coupon rate is 8%. Just find the present value of all the cash flows, you will be getting the bond value. Then along with that, you have to also compute the volatility of the bond and you have to compute the convexity. Now here I would want you people to understand one thing. In your institute study material, the convexity formula which is given is not the correct formula. It is basically an approximation formula. I am not against you people using that in examination, because actually speaking, ICAI material, it includes only that formula. Now you should be aware of one thing, that is an approximation formula, and the one that I have explained to you some time back is the actual formula. So of course approximation is still an approximation. You will get very close values, and I'll do one thing, while solving this question I will solve it either way, that is through the actual formula and through the approximation formula. For your comfort, you can follow anything what you want, and you can check on any search pages in the internet. You will find lot of search results on convexity of the bond, and everywhere the real formula for computing the bond convexity is what I have explained to you, and in all the search pages you will also find that approximation formula. Now the convexity adjustment will be carried out little differently depending upon which formula you have used actually for determining the convexity. So That will be the first part of the question. In the second part, they are saying that the desired yield rate rises by 2% in one case and falls by 2% in another case. You have to compute the revised bond value by using the intrinsic value calculation and finding the actual values or the actual change in the values, and then through volatility also you have to find that. And when you do that, there will be a gap between the value that you determine through volatility and the value that you determine directly, and that gap can be bridged by applying the convexity adjustment. So that is the role of convexity that we have learnt. So let us look into how to present the solution over here. In your solution, you will first begin with this tabular presentation, which will help you compute the bond value along with volatility and convexity. So we have identified the cash flows of the bond for each of the 5 years, including the redemption amount, the present value factors at 10% discounting rate, and then computing the present value of these cash flows. And then for the purpose of computing volatility, we will need N into PV, correct? So N indicates the number of year, PV is the present value of cash flow, so N into PV. And then when you take N into PV values, it actually becomes a platform for computing the base for convexity as well. So just keep in mind one thing here, we have taken N in place of T. You can write number of years as N or T, it doesn't matter. So if it was T, you would have taken here T into PV and here T into T plus 1 into PV. Now look at one thing, in this term where we have taken N into N plus 1 into PV, N into PV is already computed over here, correct? N into PV is already computed over here. On this column, if I multiply N plus 1, I will be getting the values for this column. Now N into PV, how did we get? N was 1, PV was 727.27, so we got N into PV. If I have to find N into N plus 1 into PV, I just have to multiply this by N plus 1 because this is already N into PV. N plus 1 will be 2. 2 multiplied to this value, you will be getting N into N plus 1 into PV for this. Likewise, for the second line, N into PV is already computed, that is 2 into 661.16 already computed over here. You just need to multiply N plus 1 to this value, that is multiply 3 to this value, and you get 3966.94. So you know what I am simply doing over here, this value multiplied by 2, this value multiplied by 3, likewise this value multiplied by 4, this value multiplied by 5, this value multiplied by 6, and again this value multiplied by 6. When you take the summation of PV of cash flow, it will indicate the bond value. When you take summation of N into PV, it will give you the base for computing the volatility of the bond. And when you take the summation of N into N plus 1 into PV, it will give you the base for computing the convexity of the bond. So let us first conclude that the intrinsic value is rupees 9,241.84. Alright friends, so let us move ahead and determine the values of volatility. That will be summation of N into PV divided by intrinsic value into 1 plus I in the denominator. So summation of N into PV we have obtained in the previous table, and intrinsic value is also obtained. Into 1 plus I will simply be 1.1 that gets multiplied in the denominator. That is intrinsic value into 1.1 will be the denominator. The numerator being summation of N into PV, and what you get as a result will be the volatility of the bond, that is 3.8922. The convexity as per the formula that we have learnt, and I told you, you can use T or N, any variable over here representing the time period. So we have used N. Summation of N into N plus 1 into PV, this value we have obtained already in the previous table. In the denominator over here, the value of the bond remains as it is, and the 1 plus I value will be taken in the squared form. So when you compute this, what you get as convexity of the bond, it is 20.097. Now, as I told you that what we have to do with this convexity will be coming up in the follow-up calculation when we talk about convexity adjustment. So let us now move ahead and try to determine the outcome of the second requirement. So here in the first case, if the yield rate increases by 2%, the yield rate will get revised to 12%. The bond value through revised yield rate we can compute by making this short table where we are identifying the cash flows of each of the coming 5 years and discounting these cash flows using 12% discounting rate. The present value of cash flows will be the revised bond value, which comes to 8,558.12. If we try to determine the bond value through volatility, the change in the bond value will be the volatility into change in yield into bond value at YTM. So it will be volatility, which we computed as 3.8922 into 2% into 9,241.84. That was the bond value at YTM. Now when you make this calculation, what do you get? The change in the bond value is 719.42. Look at one thing, because the desired yield rate has increased, or simply the yield rate has increased by 2%, the bond value is likely to fall. As a result, the revised bond value will be 9,241.84 minus the change in the value, that is 719.42. What you get is rupees 8,522.42. Now look at this value. This is the revised bond value computed directly, and this is the revised bond value which is computed through volatility. As I have explained you earlier, this value falls on the straight line, whereas this value is falling on the curve. So if you can compare these two values, there is a need of some adjustment to bring these two values close. Actually speaking, this is the proper value. It is this value which needs to be adjusted, and the adjustment to be applied over here is called convexity adjustment. Alright friends, once you have understood this whole thing, let us move ahead and talk about the second case where the yield rate decreases by 2%. So the revised yield rate becomes 8%. The bond value through the yield rate will be rupees 10,000. Here you don't need the computation. Look at this reasoning given over here. As the revised yield rate matches with the coupon rate and the bond is redeemable at par, bond value will be equal to its par value, that is rupees 10,000. Now one thing what I want you people to understand, so many times in the earlier question we have dealt with this kind of situation, that if the yield rate and coupon rate are same and the bond is redeemable at par, it is the redeemable value of the bond which will be actually the intrinsic value of the bond. So if you want, you can compute and check. You also are convinced that it will be exactly 10,000. Now if we compute the revised bond value through volatility, the change in bond value will be volatility into change in yield into bond value at YTM. When you make this calculation, it will be 3.8922 into 2% into 9241.84, and what you get is 719.42. Now the revised bond value over here will be increasing as compared to what it was earlier. So earlier value at the YTM was 9,241.84. to that you add 719.42, and what you get is 9,961.26. Now this is the approximation, this is the actual value. Look at one thing, there is a big gap between the actual value and the approximation. This approximation needs to be adjusted to bring it as close as possible to the actual value, and that is what we are going to experience through the convexity adjustment. Alright friends, once you have understood this much, let us move ahead and now we make the convexity adjustment. Convexity adjustment will be half of convexity into delta y square into 100. So convexity what we have computed is 20.097. Taking half of that into delta y square into 100 will give you 0.4019%. So if delta y is 0.02 with a positive sign, that is when it is increasing by 2%, the change in the bond value will be volatility into delta y minus convexity adjustment. So that will be 3.8922 into 2 minus the convexity adjustment. Why are we subtracting the convexity adjustment? Because the yield rate has increased by 2%. So what you will get is 7.3825%. So bond value after convexity adjustment decreases by 7.3825%. Revised bond value will be 9,241.84 minus the 7.3825%, and what you will get over here is the revised value of 8,559.56, which is closest to the actual value that we have determined directly using the revised yield rate. Alright friends, let us now move ahead and look into the other case, that is when the yield rate reduces by 2%. So delta y is negative 0.02 or minus 2%. So the percentage change in the bond value will be volatility into delta y plus the convexity adjustment, and that will give you a positive 8.1863%. That is increase in the bond value by 8.1863%. So when you make the revised bond value calculated through this revised rate, what you get is coming closest to the actual value which we have obtained. If you can recollect, the actual value that you obtained was 10,000. This is 9,998.4, almost close to 10,000. Alright friends, once you have completed understanding this whole thing, let me explain one very important matter over here. Earlier also I told you that if you look into the ICAI study material, the convexity formula what I have shown and what they have given, it is little different. That is basically an approximation approach. The one that we calculated is the actual one. The one that is used in the ICAI study material is the approximation approach. So I would want you people to understand one thing, that you can use any approach in examination, but you should be knowing that what is the actual and what is the approximation. So how ICAI has approached and the convexity calculation and the convexity adjustment accordingly will be carried out, but you will still get the similar outcome. So let me explain how ICAI would have approached this whole thing. In their approach, where convexity approximation formula is this way, it is P plus P minus 2 times P0 divided by 2 times P0 into delta y square. So what are these variables used over here? P0 is the bond price, P minus is the bond price when yield rate rises. When yield rate rises, actually the bond price will fall, right? That is why we are writing this as P minus, and P plus will be the bond price when the yield rate falls, because that is the time when the bond price will rise. Delta y is the change in the yield rate. So now when you apply these calculations, look at what you will actually get. P plus value is 10,000, P minus value is 8,558.09. These are the actual values that we have determined through the changes in the yield rate computed as intrinsic value of the bond with those revised yield rates in each case. 2 times of P0 subtracted, and in the denominator it is 2 times of P0 multiplied by delta y squared, that is 0.02 squared. When you make this calculation, do you know what you are going to get? You will be getting 10.064, which is almost half of the actual convexity value that we have computed. So you understand one thing over here, as per this approximation approach that you have applied over here, your convexity value is already half of the actual convexity. So when you apply the convexity adjustment, then that ratio of half you have to just avoid, because this is already half the convexity that you have to consider. If you look at Institute study material, they did not mention this as convexity actually. They've mentioned this as C star, and that C star is the half the value of the convexity that should be arrived at. So let me show the last part of the calculation over here, how to carry out convexity adjustment if at all you are using the approach followed by ICAI. So convexity adjustment will be that convexity that you have arrived over here into delta y square into 100, and that will give you 0.4026%. Keep in mind one thing, what we computed earlier has given you the result of 0.4019%, and over here what you are getting is 0.4026%, a very minute difference actually, but this is approximation. The earlier what we have done was the actual.